Hi, I'm Michael Yardney, and today I'd like to put some perspective on the property bubble talk. You see, if I've read one story about the property bubble lately, I've read 100. Barely a day goes by without another warning from some property pessimist, a columnist, an overseas economist about the looming price collapse in Australia. So let's get things straight up front. There's no property bubble in Australia, at least not yet. And the next point I should make is that there's not one national housing market. Prices vary widely from place to place, and always will. Now, while the Sydney and Melbourne market may look pricey, that doesn't make a property bubble. Australia's property prices are not in danger of crashing, despite record low interest rates, and despite the fact that the Sydney and Melbourne market have been performing pretty strongly. So maybe we should start off with asking, what is a property bubble? A housing bubble doesn't mean high prices. High prices could occur just in response to basic supply and demand. A housing bubble is defined by a rapid rise in property prices, where prices are a long way from what's fundamentally considered justified, and they generally occur when highly leveraged speculators enter the market for short-term growth. And it's also usually associated with strong credit growth. Now, if we want to look back at what's happened over the last 12 months, the latest CoreLogic price results suggest a rather tame market, well, other than for Sydney. In the year to March 2015, dwelling prices rose fastest in Sydney. They went up 13.9% in the year, followed by a considerable margin in Melbourne, where prices went up just under 6% last year. In Brisbane, 2.7%. In three of Australia's capital cities, however, prices actually declined. They fell marginally in Perth, Hobart and Darwin. In regional Australia, Australian dwelling prices increased by only 1.9% over the last 12 months. Now, if you want to look back what's happened over this property cycle, if you look back, you'll remember that most cities, after the post-global financial price boom, bottomed in the second quarter of 2012, and since then the cycle's seen dwelling prices rise to different degrees in each of the 8 capital cities. Sydney's been the strongest over the last years, but that follows a decade of weak property growth in Australia's largest city, and is now the result of over a decade of underbuilding, leading to a huge deficiency in stock of dwellings there. In order to get new dwelling construction started again in Sydney, we needed house prices to rise, and in fact, despite the new construction occurring, we're unlikely to make up for this deficiency when eventually interest rates rise in a couple of years' time and start to slow the market. Over the last decade, Sydney house prices rose an average of 4.8% per annum. That's hardly bubble material. And you know, it's not all about low interest rates like some people think. Sure, low interest rates have been one of the factors, but clearly cities other than Sydney and Melbourne have enjoyed low interest rates, yet their markets haven't been firing, have they? Local markets are affected by local factors, things like the strength of the local economy, which often leads to increased or decreased consumer confidence. Unemployment or job security is important also, as are local supply and demand ratios. Some people are then saying, well, what about all this high level of debt in Australia's taken on? Maybe it's a mortgage stress. Look, it's an understandable concern for some, because what they're wondering, what's going to happen to all the property owners who took on debt at this low interest rate when eventually interest rates rise. But in its recent financial stability review, the Reserve Bank found that low interest rates have made the servicing of household debt much easier, and that the level of household financial stress in Australia is declining considerably. We haven't got many mortgage distressed people. In fact, non-performing household loans are extremely low in the current interest rate environment, at just 0.6% at the end of last year, down from 0.9% a couple of years ago. Moreover, because mortgage repayments may continue to be scheduled at the same level even when interest rates are cut, many Australian households have built an enormous aggregate mortgage buffer. They're way ahead, many being more than 2 years ahead of their scheduled repayments at the current level of interest rates. Another factor that's going to protect people is that our major property markets are in fact dominated by non-investors. These are people who are not likely to sell their home if interest rates rise or if economic conditions turn sour. It's not like the share market. So what could cause our property markets to collapse one day? See, it's not as simple as some bubblers think. House prices collapse. Now, that's not the cyclical correction, but collapse when people are forced to sell their homes and there's no one willing to buy them. Sure, the market's going to turn again one day, but that doesn't mean prices will crash. What tends to happen is people choose to simply remain in their homes and wait out until things get better, and most property investors also try not to sell up. They try to hold on rather than realise their capital loss. A true market collapse occurs when a major external shock occurs, things like high unemployment, enough to trigger a wave of forced home sales. While unemployment is likely to creep up a bit again this year, no one's suggesting it's going to get to crippling levels in the foreseeable future. Or if interest rates went up so high that it would cause a raft of homeowners to default on their mortgages. Again, that's unlikely in the foreseeable future. Another thing that could cause a collapse is a recession, one that would cripple our economy. This doesn't seem to be on the cards in the foreseeable future. And the other factor that could lead to a property collapse would be a huge oversupply. Now, other than in isolated areas, we've got an undersupply of property around Australia. So looking ahead, I see this year as one of a very fragmented property markets. Each state's going to be driven by its own supply and demand ratios, but more particularly by its own local economic factors. New South Wales is likely to be the top performer with a strong, diverse economy. Victoria's economy is set to decline a little as its manufacturing base wanes, but its strong population growth is going to be a positive. Queensland's economy is driven by the falling dollar, assisting exports, and tourism. Western Australia's economy is hurting a bit as the mining building boom fades, as well as with lower iron ore prices. Finally, South Australia's economy is showing a bit of a revival, but this will be a gradual and lengthy process. Tasmania is likely to continue to underperform, and the Northern Territory economy is creaking. But we're going to be given great time with low interest rates this year, but there's also some problems along the way. There's a mixed national economic outlook. We've got some stumbling blocks ahead, and the economies of our major international trading partners are also wavering. Growth in China is slowing, and while the US is reviving, it's only just stumbling along. Locally, our government spending to try and revive our economy is going to be constrained by its high deficit and hostile opposition. And the lower Australian dollar is going to make imports, which is, thinking about it, most of what we buy, more expensive, and that'll lower our living standards a bit. And wages growth is going to remain subdued in a low inflationary environment. This is going to put a lid on housing affordability, even if rates are cut further. But there are some positives. The two big positives in the medium to long term for our property market are population growth and the wealth of the nation. If you combine both these factors, it's a powerful stimulus for property price growth. More people needing to live somewhere, and they're able to afford to pay to do so. There's little doubt that our population is going to continue to increase as Australia imports people to help replace retiring baby boomers. In fact, our population is likely to grow by about 10% in the next 5 years alone. At the same time, we are geographically situated in that part of the world that's going to drive the world's economy in the next few decades. This flood of wealth in our region is going to bode well for property in Australia, as foreigners are going to be really keen to divest some of their money into Australia. They see this as a safe economic and political haven. Some are going to buy property here to give their children better access to education, while others will buy property to strengthen their future residency visa applications. So just to put it all in perspective, all the unease about a housing bubble is unfounded. But if property values do keep rising at the rate they have in Sydney and Melbourne, which is slowing a bit now, we could get ourselves into trouble and have a correction one day, not a crash. However, as I said before, there's not just one property market, so correct property selection is going to be more important now than ever, especially if you're a property investor. My recommendation is to only invest in our big capital cities because they're the economic powerhouses of our country. Avoid regional property markets. While many Australians will have lower wages growth, others are going to enjoy significant wages growth. Therefore, invest in the type of location where these owner-occupiers, those with higher and growing disposable incomes, want to live. And in general, they're in the inner and middle ring suburbs. And then invest in the type of property that's going to appeal to aspirational owner-occupiers, those who can afford to push up value of similar properties to yours. And avoid off the plan, often new house and land packages, and avoid buying in the working class to blue collar areas where there's going to be minimal wages growth. And importantly, buy properties to which you can add value through renovations, redevelopment, refurbishment, because this year the market isn't going to be doing as much heavy lifting. Now, if you're looking for independent advice to help you become financially free, no one can help you quite like the property strategist at Metropole. We've got no properties for sale, but the multi-award winning team there have been involved in over $2 billion worth of property transactions, creating wealth for their clients. And we'd love to help you too. So why not come along and have a chat about your situation if you want to get into the market, or if you're already an investor, why not have a chat about how your portfolio is going, your existing portfolio. Contact us at metropole.com.au and we'd love to have a chat with you.